Welcome to another episode of the InvestorKit podcast, and we're here in the new studio again, but this time I'm joined by our head of commercial, Chris. How are you, my friend?
I'm good, my friend. How are you?
Good. Long time coming. We haven't obviously seen each other since, me being away with the last couple of months with surgery, but you've got some pretty big news your way to share, right?
Oh, mate, just had my second child.
How good.
Yeah, mate, life's really good.
Congratulations.
It's a blessing. Yeah.
Congratulations. Two girls as well.
Oh, man, we just had the baby the other day. Kat delivered the baby the other day, and yeah, just snuck here to do a quick podcast, but then I have to go return back to normal life.
No, look, congratulations, man. As a fellow girl dad, it's the absolute best. I am so happy for you.
Yeah, mate, thank you.
Mate, today we've got some exciting stuff. I mean, commercial's been really popular our way at InvestorKit Buyers Agency, and I just think it's that time, right? We're 6 years in as a company now. Mm-hmm. We've helped families from 2018 build residential portfolios, and now they're going, hey, the equity's good, the diversity's great, but it's time for me to go into an income journey. And I think this will be probably the next 2 years will be one of the most special times for commercial investing, because it's clear that the interest rate cycle at some point has to head down. And when you've got these net yields of today, which might not be pretty to many in some high interest rate environments, it's still far above residential. And as soon as those rates come down, it's going to be a pretty special cash flow journey for many who've been holding commercial property this whole time, right? So
Absolutely.
Pumped for that. But in terms of today, I'm keen to go through and break down the deals that look sexy to the eye, but then maybe turn out to be something else. And I know you've been going through a few deals, and today, especially on the net yield side, this is something that might be new to many residential investors. What is net yield to begin with? Could you explain that?
Yeah, so net yield is essentially the expected return an investor will receive after outgoings, but before interest.
Yeah, and how's that different to residential? Because residential, they hear the word yield,
correct,
but the top line cash and bottom line ends up being very different, right?
Yeah, so with residential, you're essentially paying a gross yield. So that is essentially, you're receiving a gross yield, which essentially means you're paying the outgoings, you're paying the land tax, you're paying the repairs and maintenance. And the difference between resi and a commercial is that commercial, that's taking care of the tenant for you. That's the big difference.
Massive difference. And so when people are chasing net yield, there's obviously certain percentages they like more than they don't like. What do you find is that sweet spot where people go, I feel good in this range?
Yeah, of course. So we typically look for something within the 6% net yield mark or above. There are a few reasons why we don't typically look for assets that have a 4.5% net yield, for instance. The biggest reason for that is positive cash flow. With the 6% net yield, you're generating more positive cash flow after covering all outgoings and interest payments. That's more money in your pocket each month, which means you're going to be recovering your initial investment quicker. So, for instance, faster payback period.
Yeah.
You're also going to increase your borrowing power with some lenders because some lenders view high yielding properties more favorably.
Yeah.
Lease stock loans, for instance. But the biggest benefit that I see with having a higher yield is more cash in your pocket can act as a cushion against unexpected or expected vacancy. For example, if your expenses go up due to vacancy, where you now have to cover the outgoings and interest payments for your property because your property is now vacant, that 6% plus net yield that you're receiving from your previous tenant is going to be covering, that vacancy, that big hole in the gap that in your cash flow. Yeah. So putting less pressure on you financially as well.
Yeah, and especially whenever I've asked someone what their end goal is with property investing, no one's just said to lose money and not receive an income and look cool, have properties and make it look really great with equity on paper. No one actually says that. Those are on the journey, sure. But no one actually says that. They say, I want to have a passive income, right?
Yeah,
and that may be passive because they want to get out of what they're doing, or it might be passive because they love what they're doing, but they just want that extra stream with some extra freedom and choice. So net yield helps. Now, when it comes to net yield, there are instances where we might look under 6%, and that's because when we see a deal we like from the tenant type, deal type, and things like that, location, we'll give that a go. But then also many people sometimes go yield chasing with 8, 9, 10%, and there can be risk associated with certain deals that present that. But we'll go into that in another episode. Yeah. For this one, you've got a deal to bring up.
Yes.
So did you want to bring up this deal in terms of talking about, firstly, a bit of the overview and what the deal's got going for it?
Yep. Yeah, so we've got an interesting property that landed on our desks recently, Arjun. It's a red rooster in Mount Gambier, South Australia, right near the Victorian border. Now, let me tell you, Arjun, on this surface, this property looked incredibly appealing.
Yeah.
We've got a brand new, well, not a brand new, but a 10-year head lease to Red Rooster, taking us all the way to 2030.
And Red Rooster's underrated, by the way. Like, I know people talk about the not being as busy, but have you tried some of their food? It's actually not bad.
I had a Ripper deal box the other day.
How good?
Yeah, mate. So we have 3 5-year option terms. Option terms meaning the tenant has the right to renew. Now, that might seem like a benefit to the landlord. It can be, because obviously you want the tenant to stay there for as long as possible, but it's really a benefit for Red Rooster. They have the right to renew. You can't just kick him out.
Yeah.
This asset is generating 87K net per annum with CPI increases built into the lease. Great for that consistent income growth. Now, Arjun, here's where it gets really juicy. Stamp duty free, being a South Australia commercial asset.
That's a big one. So, like, already I'm hearing a few things that sound pretty sexy here, right? So 10-year lease.
Yes.
Major company name. It's 10 years until 2030. So it's like maybe 6 years left. Options, increases, and at the same time, no stamp duty, right? But with this episode today, we're not talking about the beauties of a deal. We're talking about where people can go wrong.
Yes.
So that all sounds amazing to me. Before we go into the cons, are there any other pros you want to go through? Or is that
Yeah, so 24,000 square meters of land, 15,000 vehicles passing through daily because it's situated on a prime location on a highway. The building has recently been refurbished by Red Rooster to reflect its new branding, and it's surrounded by things like Woolworths, Dan Murphy's, BP, and Coles. So location-wise, it's ticking all the boxes for us.
sounds better and better as you go on?
Why don't we acquire this?
Why did we let this go?
Okay, so first of all, guess how much the agent quoted me when he sent me this property?
I mean, when we're looking at stuff, we'd want that sort of, closer to 6%, right? So I'm guessing if you're looking at it, you'd want it to look somewhere near there.
Yeah, correct. So the agent actually quoted me $1.5 million, which reflects a net yield of 5.8% for this asset.
Which for all of that stuff,
Yeah.
amazing.
That's amazing.
That's
right?
amazing. Security, you've got brand name, you've got options, you've got proximity, you've got busy roads, land size.
No stamp duty.
No stamp duty, CPI. And stamp duty is not cheap in SA. Like on the residential side,
Yeah.
it's heavy. How much was it here?
90K.
90K.
You're saving and upfront costs.
That's a salary annually for some. You know what I mean?
Exactly. But here's the thing, Arjun. You and I both know, being in the property game ourselves, that this isn't going to go for anywhere near 5.8% yield.
Our dreams have been crushed.
Yeah,
right?
correct. Let's break this down. So we've confirmed that hardly ever we've seen a fast food restaurant like this go for above 5%. Within our comps analysis, we took into account the last 15 fast food restaurants that were for sale, right?
What did you see when you unpacked there?
So when we looked at the last 15 sales, the average net yield was 4.37%.
Go figure. That's a bullish campaign start, isn't it?
Another important factor to consider is the price range.
Right.
So when we're talking sub 2 mil here, while this is not as competitive as a sub 1 mil market with, mums and dad buyers, this is still a pretty hot range when, you have buyers circling. It's when you get into the 3 and the 4 mils and above where you start to see that buyer pool start thinning out.
And that's a really good point you raise, because the majority of clients' purchases we make at InvestorKit for buyer's agency on the commercial side are over 2 mil. Like that's the aim, that's the sweet spot for us. Like we want to target that over 2 mil because as you said, the competition starts to fizzle out. The deal quality jumps up.
Correct.
And unlike in residential property where the split of yield and price just goes horribly wrong the higher you go, you can still keep it there.
Absolutely.
That's the crazy part, right? Because people sometimes look at a 500K residential property, it rents at $500 a week in some locations. Then you go to a $1 million residential property and now it's not touching that 1,000, right? They're not matching, it might be 700. Then you go to a 2 million and all of a sudden it's not that 1,400, it might be 1,000.
Correct.
So you start going, it gets worse. In commercial, this doesn't happen. No. Yes, we purchase between 1 and 2 mil, but very rarely because the 2 mil plus is where just the magic sits, right? So I note that you're saying that's very important, especially in this deal.
Correct. So we actually put together a cash flow model using the InvestorKit, the cash flow model for InvestorKit. You can go on investorkit.com.au and you can use this for anything. You can use it for resi, you can use it for commercial. So let's look at the numbers here, Arjun. For this Red Rooster, using the cash flow model in InvestorKit, we're assuming a 70% LVR, a 6.5% interest rate on interest-only terms, a conservative 6.5% growth rate. Why did we select this growth rate? Because they're simply not building these anymore. They're very rare to come by. They're very highly sought after assets. You only see 2, 3, 4 of these within a cluster of 4 suburbs. There's really not many of them. So 6.5% growth rate, very reasonable. 4% inflation rate and a 3.5% average year-on-year rental increase. Very conservative there. This is where it gets good. What did this property sell for? So Arjun, it was quoted for 1.5 million. We knew very well that this wasn't going to go for that amount.
Nah.
Guess what it sold for?
Oh, I mean, with you mentioning the 4s for yields,
Yes.
I mean, where does that take it?
So this property actually sold for 1.85 mil, which reflects a net yield of 4.71%. So that's what we've adopted
Just a
in
cheeky
this cash flow.
300K above. Yeah. Just a 20%, right?
Yeah.
Everyone gets their comps wrong by 20%, Chris.
Yeah,
Come
exactly.
on.
Exactly. I know. That's why we didn't go for this property. That's why we didn't waste any time. We didn't waste our buyer's time with this. We just knew straight away this wasn't the deal to go for. But anyway, we've run the numbers on this deal at the $1.85 million price point. Now, what was the forecasted cash flow for year one? Now, this is where it gets good. Negative $23,000 in the first year.
Ouch.
So we're already in the red just on cash flow alone.
And see, this is where it gets interesting. It's not that cash flow is bad. It's the fact that we're making this conscious move to an asset type to get cash flow.
Correct.
Right? Like if it was residential, I'd be like, hey, I'll take that. That cash flow, I'm still happy with. That's great. But the moment you tell me I'm consciously moving away from 10% deposit properties, like residential, and I'm going to 30 and sometimes even 40% properties in terms of the deposit down, I'm going there because I'm chasing something I can't get in residential. And that's the cash flow.
That's right.
But if I'm heading there and I suddenly don't get that cash flow, you've got to question the move, right? And that cash flow just shows that it's not pretty.
No.
Yeah.
You need a bigger deposit to be able to offset that cash flow. So you actually need 50% deposit to be able to be positive with this asset. 50% is a lot.
That is. And you just think of what you could do with that 50%. That could be more deposits ready for other assets that yield in that sort of 6% plus. Now, Chris, I got to ask one thing though. There's obviously people out there that do buy this stuff.
Yes.
Me and you see it all the time. We've got the amazing Burgess Rawson auctions that happen every single time. And when I say amazing, it's not for us. Amazing for them selling it. We're not participants. It's amazing for the sellers because they get some ridiculously good low yields. So they're achieving great prices. But in those auctions, there's still jam-packed rooms. There's still buyers galore. Let's put ourselves in their shoes and think why do these guys go for these deals that the analysts were thinking, looking at all the numbers, it doesn't make a sense. Do you think they have fear of other types of assets? Do you think they're just coming in and just going, I want something so safe and so comfortable? What's going on?
Yeah, so I think a number of reasons. When I used to work at Savills, the sales agents would always get, and they would sell properties out in Melbourne CBD, retail assets, and they used to sell things at 2% net yield. And I used to think, why? And one of the Asian real estate agents told me that over in Hong Kong, over in Singapore, over in China, they're used to 1% net yields.
Wow.
So 2% looks very attractive to them.
Double the value.
so that's one reason. But the second reason is maybe it's also an auction environment. They get a little trigger crazy.
Yeah.
There's emotions through the room. That could be the reason. But there's also another reason where maybe they don't know that you can get very strong assets with strong conglomerates backing them for 6% net yields. Maybe they don't know what's out there off market.
Correct.
They only know what's on market.
And another thing I think is that sometimes people are so risk adverse. They would rather go, I will sit there with this on a 10-year lease on 3 5-year options and just have this mortgage paid off. I know I could get way better results. I know I could get maybe better outcomes and yields and spread my money across multiple assets. but they become so risk adverse. They're like, I want big known brand. I want large location that's not going anywhere. And eventually these increases will catch up.
Correct.
And eventually these tenants will pay for these increases because they're in a capable business position to do that. And they don't want to let go of these assets. The expense that they'd have letting go of that area and having to restart a Red Rooster in another spot, ridiculous, right? And especially if it's their one staple in that city. So like for everyone out there that does buy this stuff, we're not bagging you. We're just saying that there could be better deals if your risk appetite sits there, right? So mate, that's great. I love going through deals like this because it shows people firstly the commercial mind. It shows what we should consider. And I think the biggest takeaway here is don't fall for everything that looks amazing at surface level. You have to dig deeper because when I look through this list, it's like lease term amazing, options term amazing, rent increases amazing, lot size amazing, traffic, refurbished property, strong tenant name. Even though like not many people rate it, I rate it. I love the burgers there. And then no stamp duty. Like all of this stuff looks amazing. Like it's just that you can get caught out in the quoted actual yields. And there's a lot of other stuff out there that we know we buy that will just shoot it out of the lights in comparison for rental yields. So mate, appreciate you jumping on and sharing this. Looking forward to doing more like this because I'd love to dive into deals. I know you promised me in the next one, we're going to go through something really interesting and more on the due diligence side, right?
Correct.
So let's do that in another episode.
Can't wait. Thanks, Arjun.